Well, it is officially noon, and I know we have a lot to cover today, so let's go ahead and get started here. First of all, good afternoon and welcome. Thank you so much for tuning in today. We know it is officially tax season, so we've got a really timely webinar for you all. Today, we're talking all about taxes, and we have special guest Ed Jenkins here to share his expertise with us. Ed is an accounting professor with the Smeal College of Business here at University Park. If you tune into these webinars frequently, you might know me. My name is Allie Smith. I'm an education program specialist here with Penn State's Sokolov-Miller Family Financial and Life Skills Center. And I'm the regular host of this webinar series, but today I'm just gonna share a few housekeeping items here before I hand it off to Ed to talk all about taxes. So as you have questions, you can ask them in the chat or in the Q&A. One of our wonderful financial literacy ambassadors, Lance, he's already in the chat here. He'll be sending a few helpful links and resources throughout the webinar. So keep an eye out for those. You are able to ask anonymous questions in the Q&A if you want to take advantage of that feature. If you are attending from the Smeal Ethical Leadership Challenge, we do have a QR code for you, and we'll share that at the end of today's webinar. Before we kick it off here, we just want to get to know who's in the room with us. So I'm going to share out a quick poll. And we would just love to know who you are, what's your affiliation with Penn State, just so we kind of get an idea of who we're talking to today.
I'm really happy to see there's a PSU parent out there.
Two, at least two. That's great. Welcome, parents. Glad to have you. All right, we've got quite a few staff and faculty, some undergraduate students, graduate students, and even some Penn State parents. So welcome, welcome. Thank you all for tuning in today. We've got some really good stuff to share with you. And Ed, thanks so much for being willing to be a guest on our webinar. That's all I had, so I'll give you the floor.
Thanks, Allie. I really appreciate the opportunity to be here and share some individual income tax information. So I'm going to switch over here and share my screen with a little bit of a PowerPoint presentation. It's going to stop Allie sharing here. And let's see if I was able to do that. So with a little luck, you're looking at a PowerPoint that has the individual income tax overview. Allie, is that coming through okay?
It looks like there's a little bit of a delay. It says you've started screen sharing, but it hasn't popped up yet. So we might just need to give it a minute here. There it is.
Okay.
I see
Now we're
it.
good.
We're good.
Okay, so hey, I'm a professor, so forgive me. I always like to focus on learning objectives. So I have 6 things that I would like you to take away from this webinar today. The first thing that I'd like you to take away is how to contact Penn State's Volunteer Income Tax Assistance Program, or VITA, for help with tax matters. And in fact, we actually prepare tax returns. So we'll give you some contact information and some context about the VITA program here at Penn State. We'll then go into a few tax items. So first up is your filing status, and we'll talk about how to determine your filing status. If you're a student or a parent here, you may also be interested in how a scholarship and stipends in some case may affect your income tax return. For those of you that are self-employed, so there's a lot of gig workers out there. We've got this new thing in our intercollegiate athletic department where students may have name, image, and likeness income. All of that stuff is self-employment income, and we'll talk about that a little bit. We'll also mention when the returns are due. So better to start now rather than waiting until the day before. And we'll talk about when the returns are due, as well as when the IRS requires estimated payments of tax if your tax is not withheld at your work, in other words, with your paycheck. Last but not least, we'll identify a few taxoids, if you will, some top tax issues that students may face today. So first up, let's talk about the volunteer income tax program. That didn't quite work, right? There we go. So VITA is an IRS program, and Penn State partners with the IRS to provide free income tax preparation and electronic filing services to taxpayers who earn less than $64,000 per year in income. And that is the level of income for 2023 per the IRS. That's not a hard number, so sometimes it's okay to go a little bit over that. The IRS isn't going to reject the return just because you're over that limit of 64,000. Now, the VITA program does sort of general returns. So some returns are out of scope for VITA because of the complexity of the taxpayer's activities. One of the activities that causes a great deal of complexity today, of course, is cryptocurrency transactions. And so those get very complicated very quickly. So if you have cryptocurrency transactions, the VITA program is not going to be able to help you. In addition to that, some self-employed tax returns, because of the complexity inherent in the folks' business, are also out of scope for VITA. But you know what? If you're in business and you're making money, unfortunately, sometimes you have to pay for that technical advice and go to a preparer. Now, at the present time, VITA and Intercollegiate Athletics partner to provide tax preparation services to student athletes at the Morgan Center. And we also have our main location in 325 Buki Building. That's right across kind of a little catty corner to the hub. So Buki Building is our main location. Student athletes can sign up and have their taxes done at the Morgan Athletic Center. Now, we also provide educational sessions, and so this is one of them. So we're working with Sokolov-Miller to help do educational sessions. We also have information available on our webpage, as well as information available in our suite at Buki Building. Now, we just opened up our webpage for appointments for this tax season. We do sort of segregate our nights a little bit. Thursday nights are non-resident or foreign student nights. Unfortunately, those appointments filled up the first day as soon as we opened for scheduling. So we'll try and fit folks in if we can, but if you're a foreign student, we may not be able to help you this year because our appointments just instantly got all booked. Our phone number is on the screen, 814-863-4147, and we are located in 325 Buki Building. Now, you'll see a link in the PowerPoint. That's psuvita.org, and you can click on that link if you have access to the PowerPoint slides, or just Google PSU VITA, and we'll come up and you can schedule your appointment right on the web page. Now, my great friend Barry Rossman is the VITA program coordinator. He runs the day-to-day operations of the program, and he trains the student volunteers and interns. So we're very blessed this year to have around 60 or 70 volunteers and interns in our program, and he does all the training, and every one of our volunteers is certified by the IRS to be competent in preparing tax returns. So Barry and our volunteers will take great care of you. I'm the responsible faculty member. I'm not so sure I should use the word responsible, but I supervise the VITA program at the Smeal College of Business. You can reach me at erj2@psu.edu, and you can reach Barry at bgr2@psu.edu. Now, as I mentioned, all of the student volunteers and interns have gone through rigorous training, about 40 hours of training, and they've passed the certification tests, and there's quite a few of them. Much of that operation and the students are really run by our club. So we're very blessed to have a student organization help Barry in the management of VITA. And our student leaders this year are Natalie Grillo, she's our president, and Katie McLaughlin, our secretary. And we could not run without their help. They do a terrific job. So now you know where to get a hold of VITA and who can have their return done for free there. I'd like to take a moment now and talk a little bit about a key sort of indicator in your return, and that is your filing status. Your filing status determines what tax brackets you use, what standard deduction you're entitled to, and a host of other metrics. So, in determining your filing status, the first key question is, are you married? And that question has a time frame. So, as long as you're married before midnight on December 31st, you're married for the whole year. So, you can consider that sometimes, I guess, in your choices that you make. If you are married on the last day of the year and you lived with your spouse, you can choose to either do married filing jointly as your filing status or married filing separately. Now, I have my software in my individual tax practice set to do that calculation automatically to see which status provides the best tax result. I've only actually had one time where we actually got a better result with married filing separately. So typically, folks don't choose married filing separately unless there are trust issues in the relationship. So one of the reasons that you may do separate filings is because perhaps your spouse is doing something illegal, selling drugs or something like that, or not reporting their income. And the reason you would file married filing separate in that case is your liability is what's called joint and several. So each of the married filing jointly folks are fully liable, 100% liable for the entire tax liability. If you choose to do married filing separate, then you're only responsible for your share of the tax liability. So sometimes, our spouses are doing things that we don't really like them to do. And if that's the case, that may affect your tax liability. You might want to consider married filing separate. But as a general rule, if you're married on at least on the last day of the year, if you're married for the year, you can file jointly and enjoy a lower tax liability than you would if you were married filing separate. Now, if you're not married, you're generally going to be single. But if you have a dependent, then you may qualify to be head of household. Now, that's important because your standard deduction is larger for head of household than it is if you were single. And so you get a tax benefit by being the head of household. To be head of household, you have to pay more than half of the cost of keeping up a home for in which you have a dependent, and a dependent can be a qualifying child, a parent, or another qualifying relative. So that's the quick sort of filing status. You can be single if you're unmarried. You can be head of household if you're single. If you're married, you can either do married filing jointly or married filing separately. And there are some intricacies there if there are separations or divorces in process, or if a spouse dies during the year, there are some complications. But for the most part, those are the four statuses that you can choose for filing your return. And as I mentioned, those statuses determine the tax brackets, as well as things like your standard deduction and a variety of other items. Now, to be a qualifying child, there are four tests. So if you're determining whether or not you have a qualifying child as a dependent, first of all, they have to be a U.S. citizen or resident, or resident of Canada or Mexico for part of the year. And then they have to have a Social Security number. So you have to have an SS number before you even look at these four tests. So assuming you're qualifying and have a Social Security number for a child, then we take a look at the relationship test. Now, the relationship test for a qualifying child is pretty much a child, but it can also be a stepbrother, stepsister, adopted or foster child. And so there's quite a list of items that are in the relationship test. In addition to that, the child has to be under age 19, or if a full-time student, under age 24. Now, the qualifying child also has to live in the same residence as the person who's claiming them for at least half the year. And guess what? They have to provide at least half of the support of the dependent. Now, if you miss one of those four tests, then you're not going to be a qualifying child. But you're not done. The person may be a dependent as a qualifying relative. And so as a qualifying relative, the relationship test is different. It's much, much broader. It goes to parents and grandparents and in-laws. So it's a very, very broadly defined relationship test. In fact, if someone lives with you as a member of your household for the entire year, they'll satisfy the relationship test. So to be a qualifying relative, it's a very, very broadly defined relationship test. And again, for the qualifying relative, you have to provide at least half the support. And then the qualifying relative can't earn more than $4,700 in 2023. So if you meet all three of those tests, even though you're not a qualifying child, but you meet the three tests for qualifying relative, then you may be a dependent of the taxpayer. Now, I have this slightly old flow chart that walks you through the process. And so you can refer to this at a later date. Please note that the flow chart has 4,300 on it, which was the level of gross income for a qualifying relative for 2021. For 2023, the threshold is 4,700. So we've figured out filing status that can be married filing joint, married filing separate, head of household, or single. And now we've sort of figured out who's a dependent. You can have qualifying children, or you can have qualifying relatives and claim them as a dependent. That's especially important when you're looking at head of household status when you're single. Now, a couple of items about dependency. Now, some of the devil's in the details here. So it's important to note that your income as a scholarship, so everything you receive as scholarships, don't count toward that support test. So the support does not include your scholarship that you receive. In addition to that, if you're a full-time student, the fact that you have an apartment or you're in a residence hall here at Penn State is not relevant because that's regarded as a temporary residence for the purpose of the residency test, and your parents' home for the purposes of the residency test is still your residence. Now, if your parents qualify to include you as a dependent in their tax return, then you can't file a tax return as a non-dependent person, even if they don't claim you. So if your parents are entitled to claim you, then you can't be an independent person. Now, that's an important issue because it determines your standard deduction. If you're a dependent of another taxpayer, then that deduction is limited and you won't enjoy the full standard deduction. Now, again, the devil's in the details. So the standard deduction is limited, as I mentioned, if you're a dependent of your parents, to the greater of $1,250. That's way less because, hey, it's $13,850 if you're independent. So it's the greater of $1,250 or $400 over the amount of income you earned up to a maximum of the standard deduction for a single person, which is $13,850. So again, your standard deduction as somebody who is dependent is the greater of $1,250 or $400 plus your earned income. And that's capped at $13,850. In 2024, that standard deduction rises to $14,600. So here's my word to the wise. The last word on dependency is have communications with your parents. And remember, if you file a return first as an independent person, and then your parents go to file their return's going to get rejected, and you're going to have a really unhappy conversation with parents. So make sure you've got good communications with your parents and that you understand, A, if you're qualifying for them or being claimed as a dependent on their tax return. So that's a little bit about filing status and dependency. Let's talk a little bit about scholarships and stipends that you may receive in connection with your education. So scholarships that are received by degree-seeking candidates are excluded from income. Yes, that's great. Up to the amount that's spent for tuition, required fees, books, equipment, and supplies. Now, the university is going to issue a form at the end of the year to tell you how much you had in scholarships and fellowships, and it'll tell you what your qualified expenses were. But that's not going to have everything. It's only going to have the tuition and required fees that you paid to Penn State. So you have to remember the books, equipment, and supplies that you spend, because that's going to obviously make a difference in how much you can exclude. So again, scholarships received are excluded from income up to the extent of the qualified expenses that you spent. Scholarships received that pay for anything else, like room and board, are included in your taxable income, and you have to pay tax on it. But don't worry, remember, you've got a standard deduction that'll sop up some of it. Now, some folks receive a stipend that's included in your scholarship received. And again, the amount above the qualified education expenses is going to be taxable. Now, scholarships that are received by non-degree seeking students are going to be fully taxable in their tax return. So that's a quick schooling on scholarships, and that's all in section 117. Now, if you're a parent who also works for the university, you may qualify for a reduction in tuition cost to 25% of the tuition cost. And guess what? Section 117 also excludes that reduction in cost that parents enjoy for their children here at Penn State from their income. It's a wonderful benefit. So that's a little bit about scholarship and stipends. Let's talk now a little bit about self-employment income. So we've heard a lot about gig workers and stuff like that, Uber drivers and people doing deliveries that are self-employed. It's important to note that amounts received arising from self-employment income are reported on Schedule C of your Form 1040. And the VITA program can help you with that. There are some limits, so if there's depreciation or home office deduction, that's going to be out of scope for VITA. But we report that self-employment income on Schedule C. Now, you're entitled to some deductions if you're self-employed, and those deductions are typically amounts that represent what we call ordinary and necessary expenses incurred for the production of that income. So if you're an Uber driver, for example, and you're treated as a self-employed person, I'm not really sure how long Uber is going to enjoy that classification. They lost that argument in a couple of places, like in Europe. But guess what? You're going to get a deduction for the mileage that you rode, or you could alternatively deduct your actual costs for things like depreciation, fuel, parking, licenses, and that kind of stuff. But most people use the mileage rate method to determine how much they're entitled to deduct for use of their personal vehicle in their business. So we have the income getting reported on Schedule C. It's reduced by allowed expenses. Key one is mileage for many folks, but also there's office expenses. You may have insurance that you get to deduct. So you have to take a pretty good look at Schedule C to what all the ordinary and necessary expenses are, because you only pay tax on the net profit, not the gross. Now, that self-employment income is subject to income tax, of course, and that's federal, state, and local here in Pennsylvania, but it's also subject to self-employment tax. Because remember, as an employee, if you're working for a company somewhere, you're going to have 6.2% Social Security and 1.45% Medicare tax, for a total of 7.65% withheld from your check. But what you might not know is your employer matches that. So the total amount of Social Security and Medicare tax is actually 15.3%. So if you're self-employed, guess what? You're both employer and employee. You have to pay tax at the rate of 15.3% on the self-employment income. And that's Social Security and Medicare, and that is in addition to the federal, state, and local income tax. So I generally encourage folks who are self-employed to sort of estimate what their profit is from their business, and then take literally 30 to 40% of what their profits are and put them in a separate savings account that you might call tax savings. And you don't touch it until it's time to make estimated payments, which we'll talk about in just a few moments. So we, again, that's a big number. So you've got federal, state, and local income tax, plus the 15.3% self-employment tax. And that sometimes is a pretty harsh wake-up call when you realize that that 30 to 40% is what you're going to need to pay your partner called the government. So unfortunately, the government is a partner in all businesses, and it's a significant cash flow. So as I mentioned, we do recommend depositing those amounts in a separate savings account so that when it comes time to pay taxes, it's stress-free. You just transfer it to your checking account, write the check. So that's our suggestion for you. Now, self-employment income includes activities like working for individuals and businesses on what we refer to as a contract basis. Now, it's important to note that the IRS has a number of programs that they use to identify relationships between people providing services and people purchasing those services. And there is a fact and circumstance test to determine what is the correct classification of a person providing services. For this purpose, we're assuming you've got that classification right. And so if you are self-employed, then you are going to be subject to all those systems of tax. In many cases, if the employer controls the what, when, where, how you do it, you're technically going to be regarded as an employee. And there was recently issued some additional guidance from the Department of Labor, and that kind of looks more like worker safety, worker benefits, and stuff like that, as opposed to the tax system. But in any event, we're going to assume that if you're self-employed, you know the difference, and your employer knows the difference. If the IRS does challenge that status, then the employer will have some unhappy consequences in terms of paying some back taxes, potentially. Now, one item that is self-employment income is name, image, and likeness income, and that's income derived by our student athletes for the use of their name, image, or likeness. So a lot of it is advertising and promotion kind of stuff. And it's important to note that your self-employment income, it's not just the cash and checks and Venmo that you receive for these activities that you do for name, image, and likeness income. It also includes property. And it includes not only property that you receive, clothing, whatever, it also includes the use of property. So if you are using, I don't know, let's just say somebody's providing a Tesla for your use, then the fair rental value of that Tesla is included in your self-employment income. Similarly, if you enjoy, let's say your parents come to town for a football game and the collective connects you with a member of the Lion Club who provides housing for your family. The fair value of that housing for your family is also included in your name, image, and likeness income. So self-employment gets a little complicated. So it's gig workers like Uber and delivery drivers. It's folks that do cleaning of houses on their own, those types of things. And it includes things like name, image, and likeness income that our student athletes may enjoy. Now, the good news is from the Tax Cuts and Jobs Act, there's a special deduction allowed for self-employed folks called the Qualified Business Income Deduction. And that deduction is just a flat 20%. So whatever your profit is, we make some adjustments for self-employed health insurance or self-employed pension plans for part of your Social Security tax, self-employment tax that you have to pay. And 20% of that modified self-employment income you get as a tax deduction. It's pretty sweet, but it's only for income tax. It's not for the self-employment tax. So that's a pretty sweet thing that was sort of engineered to compensate self-employed individuals to put them on the same footing as corporations that got a 14% reduction in their corporate tax rate in the Tax Cuts and Jobs Act. So the QBID is a pretty potent deduction to help reduce your taxable income from self-employment. It's also important to note that you may qualify for the self-employed health insurance deduction, and you may qualify for a contribution to a self-employed pension plan. And those can reduce the amount of income from self-employment that you have to pay income tax on. So things get a little complicated when you're self-employed. The VITA program will help with simple self-employment tax returns, but we can't help you if there are more complicated self-employment tax returns. So we're halfway done. I may get done a little bit early and actually have time for questions here. So I need to talk now a little bit about when your returns are due and cash flow, when the tax has to go out the door. So let's see what that has. So your individual income tax return for calendar 2023 is due on April 15th of 2024. Now, some of us procrastinate a little bit and hold back, and maybe you don't get all the information you need for your return quite as fast as you'd like. And for those folks that are missing information, you can get an extension of time to file your return all the way to October 15th of 2024. Now, I don't often tell people I know who procrastinate about extensions. But guess what? The extension is only for filing the return. It doesn't extend the time to pay the tax. So 100% of the tax has to be paid in by April 15th of 2024, even if you request an extension for the time to file to October 15th, then Uncle Sam wants the cash. So the cash has to be in by the due date. And in fact, it has to be paid ratably if you're over $1,000 of tax throughout the year. And when I say paid ratably, that means it's either withheld at work from your paycheck or you pay the tax in quarterly estimated payments. So as I mentioned, 100% of the tax has to be in by April 15th, and it has to be either withheld or paid ratably in those quarterly estimates. And those estimates are due on April 17th of 2023 for 2023 calendar year, June 15th, September 15th, and January 15th of 2024. Now, if you miss those days, well, you'll just have to pay it with the return when you file the return. If you owe more than $1,000 when you file your return, there will be some penalties associated with a failure to make adequate estimated payments. Now, there's some ways to get out of that if the facts and circumstances support it. Now, you may be thinking, well, what about calendar 2024? So guess what? In 2024, your estimated payments will be due, of course, on April 15th, June 15th of 24, September 15th of 24, and then January 15th of 2025 for your 2024 liability. So a lot of folks forget if they owe money with their return, well, guess what? The first quarter's due at the same time. So make sure you have adequate cash on hand to take care of those liabilities. Now, your individual, whoops, went the wrong way. Sorry about that. So to figure out your income, what's due on your return, we start with gross income. Now, the law in the Internal Revenue Code defines gross income as all income from whatever source derived. Well, that's about as broad of a definition of income as I can think of. Now, there are some exclusions from gross income. We already talked about some of them. For instance, the scholarship exclusion and up to the amount of qualified expenses. But pretty much it's a very broad definition. So the courts interpret that Section 61 definition of all income from whatever source derived to kind of mean the economic idea of any time you're better off or anytime you've had an accession to wealth. So that's gross income. So everything's in for federal purposes. For Pennsylvania state purposes, there are just 8 classes of identified income. And for local tax purposes, it's just earned income. And that's earned income from salaries and wages or from self-employment. So we've got 3 different definitions of income. One's for federal, one for state, and one for local tax purposes. Now, for federal purposes, you get to reduce your gross income by allowed adjustments. So allowed adjustments to gross income include, say, $300, up to $300 of unreimbursed classroom expenses for teachers. Other adjustments include the self-employed health insurance adjustment, the self-employed pension plan adjustment, and you also get an adjustment for half of the self-employment tax that you pay if you're a self-employed person. So gross income less those adjustments give us an important metric called adjusted gross income. It's important because AGI is used as a threshold for a variety of other tax calculations, for instance, in your itemized deductions. So gross income less adjustments gives us AGI, or adjusted gross income, and then we're entitled to two deductions from adjusted gross income. The first one is the greater of your itemized deductions or your standard deduction. Now, the Tax Cuts and Jobs Act really bumped up the standard deductions for everybody. The goal there was to stop people from itemizing. And in fact, the Tax Cuts and Jobs Act did accomplish that. So more than likely, you're going to be using the standard deduction. The second deduction you're entitled to, if you're self-employed, is of course the qualified business income deduction. So adjusted gross income, less the greater of your itemized or standard deduction, less your qualified business income deduction, gives us your taxable income. Now, we have to segregate that taxable income by the character of the income, but for most of us, it's all just ordinary income, and we multiply the applicable tax rate times that taxable income to determine what's our tax liability. We then reduce that liability to any credits that we're entitled to. For instance, I bought an electric vehicle this year. There's a $7,500 electric vehicle credit, so I'll reduce my tax liability by my electrical vehicle credit. But there's a host of others. There's the child dependent care credit. There's also a child tax credit. There's the earned income tax credit. If you paid foreign tax credits, there's the foreign tax credit that you may be, or if you paid foreign taxes, there's the foreign tax credit that you may be eligible for. So we reduce our liability by a variety of allowed credits. And then, of course, we reduce our liability further by any tax that was withheld at work for you during the tax year and any estimated payments that you paid during the tax year that apply to your calendar year 2023. So tax liability minus those credits and prepayments tell us how much is due with your return or how much of a refund is available for you in your tax return. Now, in my wacky tax world, I would like all of my clients to owe $999 because that means you paid in the least amount of money to the government, because remember, they're not paying you interest on that, and that you could possibly pay in and still owe $999, and there's no penalty. 1,000 and over, you're going to have some failure to make estimated tax payments. Now, most of us like getting a refund because it's kind of like forced savings, but it isn't the wisest investment to invest in a tax-free loan to your government. So it's kind of up to you. Most of us do like, as I said, getting a little refund at the end of the year in February, March, or April when your refund comes, and it lets you sort of buy that special thing you've been waiting for. Now, we've made available to you some handouts for both 2023 and 2024. And let me just see if I can bring those up and show you what I'm talking about. Share my screen with that. And so with a little luck, you're looking at key numbers for 2023. It's kind of small. Let me see if I can get that a little bit bigger. And so the key numbers include all of the tax brackets for each of the filing statuses. It identifies your standard deductions, and it also has the additional deduction if you're over 65. You get a little bonus of a deduction. So if you're married filing jointly and you're both over 65, your standard deduction, married filing joint, starts at $27,700, but if you're married jointly, you get $1,500 more for each spouse, so they stack. So $27,700 plus $3,000 for two people who are both over 65 gives you a standard deduction of $30,700. And we have some other items down here, like the education credits. These are the 2023 numbers. Some estate planning information down here. It's important to take advantage of your annual gift tax exclusion if you have some cash that you'd like to give away. And you'll see some other items, including some additional add-on taxes for things like net investment income and some other useful planning items. So let me jump back now to our PowerPoint, please. There we
I'll
go.
just jump in and say too, Lance went ahead and shared those links to those documents that we were just looking at in the chat. So if you want to download those, save those, have them for your own reference, please do that.
Super, thanks, Allie. So I'm getting back to our tax calculation. Hopefully you can use those schedules and get an idea where you're going to sort of fall into the brackets based upon your filing status. So a couple of miscellaneous items just to round out our last 15 minutes or so. It's important to note that the IRS is struggling. In 2019, we had a shutdown for 38 days of government agencies. The IRS's contingency plan was for 5 days. Now, if you can imagine the millions of paper documents that come into the IRS, they literally were stacking documents in their break rooms and cafeterias. There were tractor trailer loads during the pandemic of tax returns to be put into the IRS system at the different service centers. So between this shutdown in 2019 and then shortly thereafter, the pandemic hit and the IRS shut down again, put them way, way behind the 8 ball. And in fact, you couldn't even really call them, because if you call them, the IRS system would only let you on for about an hour, and it would actually disconnect you. The IRS referred to that as a courtesy disconnect. They were being courteous to you by disconnecting you after an hour, and then you have to call back and get back in queue. Now, the IRS got some funding in the Inflation Reduction Act of 2023. And so that funding is debated in Congress right now. They'd like to take that back. But in any event, they're spending it well. They're updating their systems. They've hired about 5,000 more people. And so they're getting kind of through that backlog and getting better. But it's important that you comply with the tax rules, do your return correctly, and electronically file it through folks like Vita, or use a software company that does e-filing, or a CPA or attorney that does e-filing, because the more you can do to make sure your return goes in correctly without any mistakes, and that means the less likely the IRS is going to have that return kicked out for any questions or potentially an audit. So remember, they're not very functional right now, so please keep everything clean. It will make life way better. If you do have to engage an attorney or a CPA, it's expensive. So please, please, please electronically file your return and keep it as clean as possible. Don't try to hack or scam the government. It's just not going to end well. So the IRS is improving. They got $80 billion of extra funding, but they're still not kind of highly functional just yet, but they're getting better. Now, the Tax Cuts and Jobs Act of 2017 that you heard me mention a couple times ends, and it ends January 1st of 2026. Now, our prognostication is Congress is going to be unable to extend it. Now, the Tax Cuts and Jobs Act did huge changes to our tax bill. We're going to revert to old law on January 1st of 2026. So, excuse me, all of the changes, and they were many and varied, from the TCJA will get undone January 1st of 2026. We don't expect Congress to be able to actually re-up that law. They're simply not functional. So it's going to be a little dicey. We've got 23 months to fix it. We doubt they'll be able to do it. But much of what I've been talking about will change significantly beginning in 2026. I should also mention that, speaking of Congress having trouble getting stuff done, there's a shutdown limit. We keep doing what's called a continuing resolution. And so remember that Congress is obligated to pass a budget for the beginning of the government's fiscal year, which is October 1st of each year through September 30th. They have not authorized a budget for fiscal 2024 yet, and they keep doing these continuing resolutions that pretty much say we're going to continue to fund the government at the same level as last year until a particular date. They just passed again another continuing resolution in the last week or 10 days. So we now have hopefully until March before things start shutting down. If things shut down, then the IRS will stop processing again, and we're going to have additional problems. So the takeaway for you is get it done before March. So if there's any way you can file your return before the IRS shuts down, hopefully our leadership in Congress won't let it go that far again. But just please be aware that things may shut down in March when that continuing resolution expires. Now, there's this item out there called Form 1099-K. Now, 1099-K is a reporting form that money service providers send into the government about the activity that you've had throughout the year. So companies like Amazon, if you're selling stuff on Amazon or eBay, would send in this Form 1099-K to the IRS to tell them how much activity you had, but they only sent it in if you had more than 200 transactions and more than $20,000 in receipts. So most small companies that have less than $20,000 in activity weren't getting reported. Now, starting in 2022, that threshold went down to $600. Now, the IRS kicked the can for 22. They kicked the can for 2023 because of software issues, both for those money service providers as well as the IRS. But for 2024, the 600 gross receipts amount will be reported. So some folks think that just because their self-employment income isn't reported, they don't have to put it on their tax return. Well, that's patently false. All income, just remember the definition of gross income from Section 61, is all income from whatever source derived. So any money you make as a self-employed person has to be on your Schedule C, whether it's reported or not. But it's important to note that in 2024, the level that gets reported goes down to $600. Now, when I say a money service provider, I'm referring, of course, to banks, securities companies, brokers, but it also includes things like Venmo and PayPal. So any means of transferring money is going to be filing Form 1099-K to report your activity if your activity is in excess of $600. Now, you may be scratching your head going, wait a minute, I Venmo my roommates my rent every month, and that's $500 a month times 12 months. Boy, that's going to be over the 600. How's the IRS going to deal with that? Well, the answer is the payor has to identify whether it's from a business or trade. And so there's going to be lots of burps in the process of getting the reporting correct for Form 1099-K this year. So please just make sure you get everything reported on your Schedule C. Now, another special thing are crypto assets and cryptocurrency. The IRS has this right in their lens. They're looking for folks that are investing in and getting paid in cryptocurrencies. So there's a question right on the very front page of Form 1040. Did you have, invest in, get paid in? Very broadly defined activity in terms of digital assets. Now we're calling them digital assets now instead of cryptocurrencies because they include non-fungible tokens. So that sort of icon of, I don't know, Kanye's dirty sneakers that you bought for $500 thinking it'll be worth 10,000 in a few years. Well, guess what? That's a digital asset. And so that, of course, anytime you sell or use a digital asset like a cryptocurrency or a non-fungible token, that is a gain or loss transaction that you have to report on Schedule D in your tax return. Now, cryptocurrency that you earn for providing services like mining of cryptocurrencies or doing rendering with your computers in your property, that's going to be self-employment income because you're getting paid for services rendered. Now, the gains that you make when you sell your cryptocurrency, that's going to be whatever you got fair market value for giving up your currency, less what you paid for that cryptocurrency. That amount is the gain. So you're going to have to report every single gain on your Schedule D. So cryptocurrency and crypto assets can make a great deal of complexity for your tax returns. And I would encourage you to sort of stay away from it unless you're ready to do the complicated reporting. There is some software out there. Coin Tracker is a great piece of software for managing your crypto assets. And some of the software will actually go out to your wallets and bring your activity from your wallets and then hopefully categorize them correctly. So crypto assets are a big current issue to keep in mind. There are two other things I do need to make you aware of. Generative AI is a reality. I'm looking at it extensively from an academic and a business perspective. I was just in a meeting with folks talking about personal financial planning, and one of the attorneys said he got a call from his son who said he'd just been in an accident and he had been drinking and he needed to get cash from dad as soon as possible. And this attorney said he swore it was his son. It sounded just like his son. And it turns out it was an artificial intelligence utility that was mimicking his son's voice. Keep in mind, all the stuff you put in your social media can be scanned. Your voice can be then recorded and used in generative AI. So please understand our world is moving very quickly in this time of very fast technology, and it's affecting taxation. So please get what's called an IP PIN. That's an identity protection personal identification number, and just Google IP PIN on the IRS webpage and get your IP PIN. You can get it on your phone from the IRS. And remember that the first person that files your return is the person that gets the cash. So if somebody fraudulently files your return for you before you do, they're going to get the cash and you will not have any recourse against the IRS. The IRS doesn't say, oops, shouldn't have given it to them. Your IP PIN is your best way to prevent that, because a return can't be filed once you have an IP PIN without having that IP PIN in the electronic file. In addition to that, if you do have business entities like LLCs or corporations, there's a new reporting regime that went into play January 1st called beneficial ownership information. If you do have an entity like an LLC, I've got one, Jenkins and Company LLC, you're going to have to report to the Financial Crimes Enforcement Network about the ownership of your LLC. So if you're involved in any of those kinds of entities, make sure you get a FinCEN identifier number. And what that means is you'll go to the web page for Financial Crimes Enforcement Network, fondly known as FinCEN, and you'll do some self-identification. You'll need your ID information. And so they'll give you a number. Now, the reason that's important is for any company in which you're invested, when they call and ask you for your personal information for the BOI report they have to do, you can just say, hey, my FinCEN number is this. If you don't do that, then the company that's doing the reporting is going to ask you for that identification, your social security number, and some other personal information. And I don't recommend giving that out to folks. So the only place you really should do that is go get your FinCEN identifier number from FinCEN, and then all you have to do is report that ID number to them. Now, I do want to mention Sokolov-Miller Financial and Life Skills Center has awesome education available to help you in your own personal financial planning. A lot of students don't have a budget, or maybe it's just kind of in the back of your mind. I do recommend that you do use a budget. And so you'll see a link here to the Sokolov-Miller Family Financial and Life Skills Center. Please, please, please get a budget, and that will help you actually amass some wealth, not a bad idea, and will also help you be way less stress-free because you'll have money there when you need it. If you do have a business activity, a self-employment, please consult with legal counsel regarding the need for whether or not you do need an LLC or a corporation to provide liability protection for your self-employment activities. Please also make sure you consult with an insurance advisor about your self-employment activities to make sure you're covered. So some car policies, for instance, don't cover you when you're using your car for business activities instead of just your personal activities. So please make sure you've got appropriate insurance coverage for your self-employment activities. Now, generally, if your income is under 65,000, we'll do your return for free. So please connect with us at Vita, psuvita.org. I should mention to you that I'm talking about US taxation for citizens and residents. If you're not a resident or citizen of the US, then you're a non-resident and different rules will apply to you. VITA can help non-residents as well, but many non-residents may actually need to hire a tax advisor. I did it. I got done in 55 minutes, Allie. I'm going to stop sharing my screen and see if there are any questions from our audience.
Thank you so much, Ed. That was so much information, very helpful. There are a ton of questions.
I know it was
Um,
mind-numbing, and sorry about that, but it is tax.
you did great. Thank you. There is a question buried up in the chat that I'll just ask regarding VITA. Is it 64,000 per household?
It's 64,000 per return. So in that case, a married filing jointly person would be 64,000 for that return.
Okay.
I guess that would be the household.
Okay. Yeah, that's good to know. Okay. Can you see questions? I can fire them off too. We have a question about grants and how grants work. You explained how scholarships work. Are grants similar in
Um,
tax structure?
grants, fellowships, and scholarships are all going to be, if they run through the university, they're all going to flow through your reporting from the university. But if you receive a grant, it's going to either run through the university, in which case it'll run through your role as either a student or as an employee or researcher. If you get it directly, then that is likely going to be self-employment income if it doesn't run through the university as your student or employee relationship.
Got it.
So I think
Okay.
it says, with so many staff working from home, are there deductions we can take based on the home office setup? This is the big travesty of the pandemic. The Tax Cuts and Jobs Act ended the home office deduction for employees, not for self-employed folks, but for employees. The miscellaneous itemized deduction was the home of the self-employed tax deduction, and that went away in the Tax Cuts and Jobs Act. But as I mentioned, the Tax Cuts and Jobs Act dies an ugly death December 31st of 2025. So we may enjoy that deduction again in 2026 with a little bit of luck. But that, of course, happened December for 2018 tax returns. And of course, the pandemic started in 2020, and many of us started working at home, and there's no deduction for that now.
Okay, that's good to know. I guess we can cross our fingers that that might come back.
And so I have another question if I have time. It says, what if I get, will I still get the self-employed income tax deduction if I have both a W-2 and self-employed income? And the answer is yes, you'll still enjoy the QBID, but only with respect to the self-employment income. We're not going to, of course, give you the QBID with respect to your employee income. Have another question if I have time. Of course, I have the time blocked by my software here. So what if I get a corrected W-2 from an employer after filing and after tax day? Well, the answer is you'll have to file an amended return if you've already filed your tax return, but that's only assuming that there's a change in tax. Sometimes you get a corrected W-2 to correct something else. But if your tax changes, you're obligated to file an amended return. And if you qualify for VITA for your original return, we'll also probably do your amended return for you as well. And the IP PIN is not the control number. And I don't really know what TaxSpring is. I'm assuming that's some kind of software. If you have an IP PIN, you'll get a letter and notice from the IRS. And so you'll definitely know what your IP PIN is. I think I'm out of time.
Yeah. Do you want to take like maybe a few more minutes of questions? If not, that's okay. We
So I
can.
have what is considered a simple return. So a simple return for us are wages and salary income that you get on a W-2, maybe some interest in dividends or light capital gains if you've got a securities account. But it gets complicated when there are cryptocurrencies or when there's self-employment income that includes depreciation or something complicated like a research and development credit. So a simple return, as the name suggests, is it's straightforward without complicated tax law.
All right. We have looks like maybe one or two more questions in the chat. I can just read this one off because I'm looking at it.
Okay.
If a now senior in high school who is planning on attending college this fall was awarded scholarships last year in 11th grade, does that need to be reported on her 2023 taxes?
I'm going to have to give you a depends, it depends answer. I'm assuming the scholarship went to the university at some point. If it wasn't jointly written out to the university of choice and the student, and the student cashed it and used it, that's going to be taxable income in the year it was received. Now, most scholarships end up getting deposited with the university, and then they're appropriately reported on your form that you get at the end of the year as a student. I hope I answered your question okay there.
Yeah, that was great. Last one looks like I have a high school student who works. I claim her as a dependent on my return. If she makes below a certain amount, she doesn't need to file a return, correct?
That's correct. Generally, that amount is the standard deduction. So for a dependent, that would be $400 plus it'd be the greater of $1,250 or $400 plus her earned or his earned income. Now, I should note that if there's a refund coming, you want to file the return. But if there's no refund coming, then the answer is you don't have to file a Form 1040 for that person. But you do have to file state and local.
Okay. I think we got through them all. Thank you so much, Ed. This was really helpful. It looks like you've helped a lot of people debunk taxes, which is always the goal, right? Before
And we
you
try to
leave,
keep everything clean.
yes.